The countdown is on. Everything you need to get the edge at the end of the market day. This is The Close.
The geopolitical risk premium gets put back into the market slightly. Live from Studio 2 here at Bloomberg headquarters in New York, I'm Romaine Bostick.
And I'm Katy Greifeld. We're kicking you off to the closing bell here in the U.S. And let's talk a little bit about that geopolitical risk, because at one point today, the S&P 500 was lower by more than 1% as you see Brent oil really climb here. But you can see a lot of those losses being clawed back right now, especially when it comes to the Nasdaq 100. Brent pretty much holding its move. I mean, at one point we were getting close to $80 a barrel, still hanging out around 78 barrels. And then that clawing back, it also applies to what we're seeing in the bond market right now, because initially you had yields really rise. Now you can see we're still higher on the day when it comes to that 10-year Treasury yield, but only by about 1 basis point, Romaine, though I will say that we are getting closer to 460.
Absolutely. Some interesting moves outside of the equity space, but overall, that clean peace dividend trade that it effectively began back in May, that is being hedged just a bit. Traders right now really trying to assess just how seriously should you take Trump's latest Iran escalation beyond today. The impact is tangible for today as Brent crude oil prices, as Katy just showed, higher. In fact, they had slid 30% over the past 6 weeks to a 4-month low, now up 9% over the past 2 days. And that jump in benchmark Treasury yields, that has the 10-year at its softest in 5.5 weeks. Now, the real tell to keep an eye on, of course, is what's going on in inflation-adjusted yields, which have crept to the highest in more than a year. Resurgent oil prices, a still too strong economy, rekindling speculation that the Fed will raise rates sometime this year. Just an hour ago, the markets got another reason to bet that is indeed the case. The FOMC releasing its minutes from that mid-June meeting, and it does show a lot of chatter about whether to elevate rates to combat elevated inflation.
The inflation concerns are back in play, and as a result of that, the Fed is back in play. Not only is the Fed pivoted to tightening, but they may actually have to tighten.
Now, all of this coming at a particularly inopportune time for the market, which was already facing questions about the durability of the AI trade, a trade responsible for the lion's share of the stock market gains this year. Before this week, those concerns, they were at least being offset by, well, falling energy prices and, well, falling inflation risk.
Let's talk a little bit about how it's all feeding into sort of the market expectations of what this Federal Reserve is going to do. Because even with the bump up that we're seeing in oil prices today, take a look at the divergence that has really developed when you take a look at WTI crude. That is your blue line. In white, you have 2-year Treasury yields. As Romaine mentioned, yields on the 2-year tenor really reaching the highest that they have in quite a while here. And it's going to be interesting. I mean, we saw those Fed minutes, the active discussion over whether or not there should be a rate rise when it comes to June. When it comes to the Fed's inflation concerns here, we know it's not just energy. And I think that that's really nicely shown by this chart here, because this market is still bracing for a hawkish Fed, even with this big downdraft that we've seen in oil over the past several weeks, Romaine.
Absolutely. Tony Rodriguez joins us now here in Studio 2. He's the head of fixed income strategy over at Nuveen. And Tony, it was kind of funny. I was actually just reading one of your updates that you had. I think you published right at the end of June, and you were kind of talking about the drop in oil prices and how that's feeding into a more attractive picture in the fixed income space. I am curious. I know who knows what's going to happen geopolitically, militarily, but do you have any sort of sense here that you might maybe have to adjust that outlook that you had just a week or so ago?
Yeah, certainly if we get back to where there's actually, military activity that accelerates from here, then clearly the, sustained oil prices in the 90s, 100, that definitely shifts out our inflation forecast, and that means the Fed may have to react sooner. In the more likely case, we think that there'll be kind of a return to a quasi-ceasefire environment, and you get oil prices settle into this kind of mid-70s area. Then we think the Fed will probably be able to stay on hold through the balance of the year until they have a cleaner-eyed picture on what inflation is going to look like in 2027 and what the economic picture particularly unemployment will look like in 2027.
One thing I am curious about, too, is, I mean, you're seeing the entire curve shift higher modestly today. There was a pretty more significant shift higher in the curve yesterday. And I am curious as is actually what you think that is reflective of. Is that sort of concern about inflation? Is that more of a term premium, supply issue? I mean, what does that price action tell you?
Yeah, I think that was being driven much more by kind of the term premium supply questions. We were coming, it was right on the heels of Amazon coming obviously with, the quote unquote drive by 25 billion. And that was really just highlighting the enormous needs for financing, both in the equity capital markets, whether it's corporate credit or structured finance or private markets from all of this AI investment. And I think that was the bigger piece driving that kind of rise in yields that we saw yesterday.
And so I'm glad that, we've transitioned there talking to a little bit about the debt raising that's going on when it comes to a lot of this big tech spend, because we saw that interesting deal from Amazon this week. And you think about the reception. I mean, it pulled in 1.6 times as many orders as the bonds that were actually offered, which is still oversubscribed, but still well below what we saw when they came to market just 4 months ago. And I wonder if there's anything we can take away from that, anything we can extrapolate out from that, or whether it was just a bad day.
I think what you see is basically just a little bit of an indigestion problem in the capital markets because the needs are so large, right? 600 or 800 billion this year, going to $1 trillion over the course of the next couple of years. So you're going to see a variety of things. One is you're going to see, I think, new issue concessions are higher in the credit market. You're going to see a slight widening in spreads. We've seen that in the high quality investment grade credit market because outside of an Oracle, which is in the triple B space, most of the other hyperscalers are AA and single A. And what you've seen, if you look year to date, triple B credit spreads are actually tighter in the year, higher quality or wider, right? And that's largely driven by this enormous amount of supply coming in that segment of the market, that high quality, long duration area driven by the hyperscalers. I don't think there's going to be a problem with it actually getting financed. It's just that it's going to have to come at a slightly cheaper level in order to attract investors.
And so, I mean, thinking about that indigestion, we were actually talking to Jordan Jackson from JP Morgan on The Close yesterday, who made the point that, when it comes to your fixed income portfolio, you have to start thinking about concentration risk. When you think about all the tech issuance coming through, there was a really interesting story on the terminal about traders basically having to dump tech bonds to make room for this Amazon debt deal in particular. But even outside of this offering from Amazon, I have to imagine that sort of churn is going on in the tech portion of a lot of bond portfolios right now.
That's right, because if you look at tech, say maybe back to the start of the year last year, it was probably that kind of 4%, mid-single digit range. Now we're up to like 7-8%. You look in the equity markets, you get numbers of 20 and up. So it's not at those levels of concentration. Finance is the biggest segment of the investment grade market at around 20%. We're still in that kind of mid to upper single digit numbers for tech. So we think there's some, space for additional supply. But again, it comes with a little bit of a larger concession as investors do need to make room in their portfolios. So the broader market, therefore, ends up at a wider spread level than if we hadn't seen this kind of massive issuance.
I do want to kind of circle back to the inflation question, but specifically when it comes to a lot of this corporate debt issuance and the AI build-out, there's been a lot of talk about concerns that the AI build-out itself is inflationary. I mean, we have some evidence of that, whether that gets offset or not. How do you kind of square that circle with the idea that as these companies continue to spend in this space and that pushes up prices of components and everything else, does that have a circular effect back onto yields? And maybe not necessarily for them, but certainly for the rest of the market?
I mean, I think at the margin it does. I mean, we definitely don't think that, AI is going to be a primary driver of broad-based inflation. It's going to be more narrowly focused, like DRAM prices, which are enormous. And when you think about the indexes, there's some methodological changes that are being made about how the, technology segment is contributing to PCE. So at the margin, we do think it's an elevated level. We had been forecasting at the beginning of the year that you'd see core PCE at around 2.5% by the end of the year. Now we're saying 3%. That's largely on energy prices, but it's also partly on the technology effect, the AI effect to broader prices.
All right, Tony, I really appreciate it. Always smart. Tony Rodriguez, head of fixed income strategy over at Nuveen, kicking us off to the close here on this Wednesday afternoon. Coming up, a deeper dive into the world of tech investing, from where the longest term value lies to capital allocation. Songyee Yoon, founder and managing partner over at Principal Venture, going to be joining us in just a second.
We'll also take a look at how the tech companies themselves are investing and how their strategies might pan out with Mark Douglas, the CEO of Mountain.
And we just learned, of course, a few days ago, President Trump touting a move by Toyota to move manufacturing of its Tacoma truck from Mexico back to the U.S. That, believe it or not, is a deal that dates back a couple of decades, and it has a lot to do with the man on your screen. We're going to catch up with former U.S. Department of Housing and Urban Development Secretary Henry Cisneros. Stick around. This is The Close on Bloomberg.
Well, rate hike worries weighing on the price of gold, with the U.S.-Iran ceasefire now over, according to President Trump. Our next guest writes in his latest note, a hawkish Fed pivot shouldn't change the structural post-COVID dynamic for gold. Joining us live, I'm pleased to say, is Aakash Doshi. He is global head of gold strategy over at State Street Investment Management. Great to have you with us. I'm taking a look at your notes. You're still targeting $5,000 an ounce into early 2027. Give us the recipe that brings you to that level and how the Fed factors in.
Sure, Katy. So the Fed factors in as being a bearish headwind in the very short term. The market is now pricing in 1.5 hikes for 2026. If we look before the Iran war, we were looking at 2 to 3 cuts from the Fed this year. And then the dollar has recently strengthened in that period since the Iran war began in March. That being said, I think the structural factors supporting this bull case for gold in this cycle since 2024 remains largely intact and could be exacerbated by the war. So what are those factors? First and foremost is global debt loads continue to rise, and more particularly, the government share of debt continues to rise. And that could be exacerbated by this war because military spending will be higher. And you also look at energy subsidies in emerging market economies. I expect global government debt to actually continue to rise at a faster pace on the back of this in 2026. I think the other factors are, from an asset allocation standpoint, stock-bond correlations still remain elevated. Gold has lost value since the Iran war began, and we had this oil price shock. The 60-40 portfolio hasn't been resilient as well, and U.S. government bonds have actually lost value since the start of the Iran conflict as well. And this fiscal and inflation impulse could exacerbate that. Physical demand for gold still remains strong, particularly from China retail and central banks. And then lastly, I would say gold ownership globally is still quite low. If I look at gold fund ownership as a percentage of global mutual fund and ETF assets, that's still less than 1%. So not really a crowded trade from a strategic allocation standpoint.
Yeah, that's what I was wondering about. I mean, you think about the ETF story. Certainly, we saw enormous demand into gold-backed, gold-based ETFs, especially in 2025. In 2026, the story has changed. I mean, we're taking a look at year-to-date outflows, and you think about that flow picture. How important is that here when you think about, again, some of the levels that you have in mind?
Yeah, the flow picture is important, but I would also bifurcate where the flows are coming in and where they're going out. So a lot of investors, especially in the US, where we're speaking from, are going to focus on Western investor flows. And to be sure, after record inflows seasonally in January and February this year, you saw redemptions, record redemptions in March, and balanced flows in April, May, but then large outflows in June, about $5.3 billion for the US listed sector for June. However, China and Asia Pac broadly have continued to buy that dip. They did have sales in June, but broadly year to date, well over 10 billion of inflows coming in from gold ETFs from China and Asia Pac. So I do think that's helping mollify or at least buffer some of this redemption trend. To me, we're starting to see a little bit of stabilization in the gold outflow trend following the June FOMC. To the extent that we've reached peak hawkishness, oil prices stabilize in kind of around the $80 range. I actually think they got low, falling below pre-war levels. We stabilize here. if you have peak hawkishness, gold can survive with the Fed on hold so long as the cuts are not actually materializing, hikes are not materializing.
Yeah, I am curious, Aakash, a little bit more, if you can talk a little bit more about the central bank buying or lack thereof. And I know we've gotten some recent data out of the PBOC and a couple of other of the big banks here. What is actually going to drive that continued purchase? Is that going to be a function of the moves that we've recently seen in the dollar relative to those local currencies?
If you look at central banks, they're not buying for alpha in year 1 or year 2. They're buying for geoeconomic and geostrategic reasons, reserve diversification, de-dollarization trends, holding gold as a physical alternative fiat asset that has no credit risk. So this is a multi-decade trend, in my view, that began in the global financial crisis. And if you look at the recent central bank surveys that we've run with our fund sponsor, we are seeing a record amount of interest in gold from the official sector, a record 46% saying that they plan to add or maintain their gold reserves over the next 12 months. A record 90% expecting the dollar share of reserves to stay flat or fall over that same period. So I think from that standpoint, this official sector demand pull is still in the middle innings. Many governments also have targets to increase gold holdings over the medium term, or for emerging market central banks to normalize gold holdings so they're more in line with the Fed, the Bundesbank, and others. So I think that tailwind has legs. I wouldn't look at just any 1 month of data. But you just look at the broader trend since GFC. It's been very positive.
All right, Aakash, got to leave it there. Appreciate it. Aakash Doshi, Global Head of Gold Strategy at State Street Investment Management. When we come back, we're going to take a look at, well, another earnings report. We're going to hear from Levi after the bell tonight. We're a lot of questions right now whether the brand can actually push beyond denim. Does it have legs, Katy Greifeld? We're going to set you up for what to watch out of that report when we come back here on The Close, right here on Bloomberg. Let's get right to our top calls, the big movers on the back of analyst recommendations. And we start off with Bath & Body Works. Kate McShane over at Goldman downgrading to the only sell rating among the more than almost 24 analysts covering the stock. She cites evidence that consumer sentiment for the soap and candle seller is actually trending below historical average, and says an expansion of distribution deals with Amazon and Ulta could cannibalize from the company's own retail stores. Those shares down for a 6th straight day. Next up, Dollar Tree. Raymond James upgrading to outperform, citing easing headwinds, better execution, and improving store traffic trends as the main catalyst. Those shares up for a 2nd day. And finally, Alcoa. Morgan Stanley downgrading the aluminum maker to equal weight and slashing the price target to a near street low $53 a share. The firm says it's concerned about an impending metal surplus that will depress prices and exacerbate the weight of Alcoa's debt load. Those shares down 10% over the past 2 sessions and now down more than 40% since that year-to-date high in early June. We do not want to turn our attention to Levi's. The retailer set to report earnings after the bell as it attempts to push beyond the denim category into a more diversified direct-to-consumer operation. Joining us right now to talk a little bit more about this is Deborah Weinswig, founder and CEO over at Coresight Research. All right, Deborah, this has been kind of a bit of a turnaround story. They've done pretty well in the last couple of quarters. Obviously, we can start with DTC, for example. This is now more than 50% of their sales. I know they've seen some growth on the wholesale side of the business, but I am curious as to whether they're potentially going to fall into a trap that some of these other retailers have fallen into that have made these bigger pushes into selling directly to their consumers. Are you comfortable with more than 50% share in that DTC space?
It's a shocking number, Romaine, as you pointed out. And I think that what it tells us about Levi's is that their fit is incredibly consistent, because retailers start to have issues really with kind of their customer relationships if fit is off. But if you've got over 50% of their sales happening in the D2C channel, right, direct to customer, that tells me that their fit is incredibly consistent, and that once the customer tries the product, they know that they can go back and buy that size again and again and again, even in different styles.
I am curious, though, then, as they sort of do that, and we're going to talk a little bit about some of their expansion beyond denim, but I do want to talk about denim specifically, because that has actually helped them a lot. We've kind of been in an upcycle fashion-wise overall that has benefited Levi and others. We were just actually talking off air. My son likes to wear baggy pants that are like 3 sizes too big for him. These loose silhouettes. I know they've driven a lot of replacement and they're popular, but you know, fashion is very cyclical, and I do wonder how much longer the current trend goes and whether Levi is actually positioned for some sort of transition away from the current trend.
And that's really important because if we think about what's happened in the denim category, many of those retailers have done extremely well, whether it's American Eagle or Gap or Guess or Abercrombie. And so we're in a bit of a denim cycle. As you alluded to, it's this kind of moving from skinny and bootcut to more baggy style. And I think that this whole topic leads into, right, the beyond denim, because I feel like Michelle Gass, right, who has an incredible background, you know, between Kohl's and, you know, running loyalty at Starbucks, I do feel like she kind of anticipated the shift, and hence the Beyond Yoga, not only the acquisition, but the continued growth there.
Let's talk a little bit about Beyond Yoga, because, I mean, reading through your notes, you talk about how this is another important growth platform for Levi's. We know that athleisure, the category, has not been without its struggles, both due to those silhouette shifts we're talking about, but also the fact that it's a very competitive space. So how do you see Beyond Yoga positioned within that environment?
Beyond Yoga in that environment is increasing their focus on men's. And what we've seen is that, I would say, a more dressed up as opposed to, you know, shorts and denim with holes, et cetera, as people are, you know, continue to spend more time in the office. So whether it's going from 2 days to 5 or, you know, whatever it looks like for each individual. And, you know, companies like Vuori and Lululemon have seen that contribute meaningfully to their growth. And, you know, there's always room for a third player in that. And I think that Beyond Yoga, the difference to me is the focus on technical. And so the consumer, I think, as they get to know the brand better and they think about what they're spending on a product that's more technical is one that I think works in the near term, medium term, and long term. And that's why I think that's incredibly interesting.
And Deborah, we only have about 30 seconds, but as you mentioned, I mean, Beyond Yoga was an acquisition that was back in 2021. Do you think that more M&A could be anywhere on the table for Levi's?
It's funny, I've been thinking a lot about that. And if you think about how they kind of foresaw this growth in, call it, you know, athleisure, especially men's bottoms, I do feel like there's another one up their sleeve, and it's on kind of where they think the market will be in like 3 to 5 years. So I think it's a great question, and I think they're uniquely positioned to not only acquire, but integrate well.
Well, it'll be fun to watch. Deborah, great to get some time with you. That is Deborah Weinswig. She is founder and CEO over at Coresight Research. Now, coming up, big tech's big bond sales being met with more scrutiny. We'll unpack whether markets are mispricing AI companies with Songyee Yoon, a director on HP's board and founder of early stage AI VC Principal Venture Partners.
3:30 p.m. here in New York. This is the countdown to the close. I'm Romain Bostic.
And I'm Katy Greifeld, of course, keeping an eye on these markets, really tracking the demand for the AI trade when it comes to the stock markets, when it comes to the bond markets. We've been talking about that Amazon deal, that debt deal that they came out with, the fact that it was still oversubscribed, but to a much less greater magnitude than maybe an offering they had just 4 months ago.
Absolutely, and it's kind of bringing into, I think, a further light the idea of how exactly we're supposed to value this whole build out. Not necessarily Amazon itself, obviously, but obviously the data centers, the debt underpinning it, and more importantly, some of the deals with, I guess, some of the companies that maybe aren't as strong as an Amazon or a Microsoft. Or,
Absolutely. Yeah, you think about these long-term contracts that are getting signed here. A lot of questions out there. So let's discuss all of this and more with Songyee Yoon. She is a director on HP's board since 2025, also the founder and managing partner of Principal Venture Partners. It's a VC firm focused on early stage AI native companies. Great to have you with us on set. There was a really interesting line in your notes. You know, you talk about how the chip cycle and the hyperscaler cycle, they're beginning to diverge here. We've certainly seen that when it comes to the equity market performance as well. And you write that the more important question here is whether hyperscalers will pull back on their spending as the AI build out becomes increasingly costly. And that's exactly the question I want to ask you, because that's pretty existential when you think about this AI trade overall.
Yes, I mean, I think that we are at the moment that we kind of witnessed the nature of the game is changing. Over the last 5-6 years, it has been a race for scale. So who can get to the kind of the scale first, who can roll out the application first, but like now they're paying attention to efficiency. So now the race is becoming the like a race for efficiency. Who can do it at the reasonable ROI, and where does the kind of return on investment is going to come from, is a kind of question that we're kind of starting to ask.
And it's interesting because, I mean, you know, you mentioned the race for efficiency, you know, a lot of scrutiny when it comes to ROI. I mean, you put it together, it sounds like just necessarily spending a ton on CapEx, funneling a whole bunch of money into this build out, that isn't necessarily the winning formula anymore.
That's right, absolutely. I mean, I think that's the point that I wanted to emphasize, that over the last 5-6 years, it has been a game of capital. So like who can pour more capital at speed seem to be winning the race. What hasn't changed is AI is a transformative technology, and it's gonna be like weaved into the fabric of our society in the coming decades. However, how it's going to be made is going to come from more kind of achieving more efficiency and putting more engineering effort to make it work better with a lower cost. Imagine what it was like when the mobile phone was first introduced. That there was a phase of the kind of the proof of concept. Like I think some of us still remember what car phone looked like. Mm-hmm. It took up 1/3 of the space within a car. It was a great proof of concept, but if we kind of overbuilt ecosystem around that very product, it would have become obsolete very quickly, because it took decades from what it was like when in the car phone age to an iPhone in our pocket. There's a lot of engineering innovation that took place from making that product to become in the hands of everyone. That's what's happening with AI. The cost of intelligence should go down to make it more affordable and accessible to greater population around the world. And I think a lot of engineering innovation will come out. And we're not certain if today's data centers and infrastructure, the way it is going to be suitable for that kind of future demand.
Well, that's what I'm curious about. Where are you seeing right now in the early stages that type of engineering that might actually end up being the realized future of AI?
Yes, I mean, I see like a lot of the early stage companies. That's why I'm very excited to work with these early stage founders who are solving the very engineering problems. How we can make compute more efficient, how we can make the like AI and intelligence affordable at like a lower cost, how we can optimize in terms of the kind of amount of data needed, amount of compute needed to get to the similar level of intelligence that we see today. I think those are the all open questions, and a lot of the founders are kind of racing to get there.
Is that what, when we look at, and we don't have to mention specific companies, but when we look at the big companies that now are sort of leading this charge, do you think they're trying to work towards that, or are they more just focused on whatever the sort of land grab is, for lack of a better phrase?
I'm sure that like a lot of people realize it's a kind of that they're turning tide, that we have to also focus on like a bottom line cost and efficiency, instead of just kind of showing that technology demonstration. So I think there is a lot of effort going into it, but always, I mean, if you look at the history of innovation, there are like the small companies are agile and they're better positioned to kind of come up with the new solutions that completely kind of transformative ones, because they don't have the baggage and legacy. So.
Do you see the potential in the near term for consumer-facing products, so more than just the chatbots for us to ask questions, actually being available, and more importantly, actually being useful?
Of course, yes, yeah. I think it's a kind of the AI chatbot is not the only AI. I mean, I think we have to see this revolution as a more kind of adoption of the more software. What we have to recognize is kind of that the cost for producing software has come down significantly. So in the industries and businesses which could not benefit from the advance of like availability of data and a lot of software will benefit from it, will achieve the level of automation, quality improvement, and efficiency. So I think those are the things that we'll expect, we can expect to see as the AI development and innovation continues.
And I want to situate what we're talking about in the macroeconomic backdrop because, this innovation that we're talking about, it's not happening in a vacuum. So, you think about where we sit right now. We're talking about higher for longer interest rates, the idea of interest rates and thus the cost of capital going higher. How is that impacting the conversations that you're having with founders today, if at all?
I think that, another aspect of working with early stage founders is that we're reminded every day the innovation and creativity comes from scarcity. So those are trained, those are the ones who are trained to work with the very limited resources. So in the backdrop of macroeconomic volatility, I think that they are trying to find the principled approach, finding the solution and breakthrough through the innovation and engineering effort rather than pouring a lot of capital into that.
All right, Songyee, great conversation. Great to actually have you here on set. Songyee Yoon there. She's the founder and managing partner of Principal Venture Partners. She's also on the board of HP and, of course, a former founder herself. When we come back, we're actually going to talk about what's happening in the public market. We're going to take a look at the ADRs of Alibaba, up about 12%, having their best day in more than 10 months on rising earnings optimism, as a lot of the investor interest in the AI space is actually now starting to shift back to some of those Chinese tech names. That conversation coming up after the break, right here on The Close, right here on Bloomberg. It's time now for our stock of the hour. We're taking a look at the U.S. ADRs of Alibaba. They're on the move higher as investor appetite for Chinese tech stocks actually grows. Traders, they're also pointing to a positive earnings preview the company conducted with sell-side analysts for its next quarter. Those results are estimated to come out in late August. The shares of Alibaba now having their best day since last August. Bloomberg TV markets correspondent Nora Melinda joins us right now to talk a little bit more about this. So kind of put this into perspective. I know they had the pre-earnings update, but it seems like there's something a little bit more that's actually just driving the shares higher.
Well, we're seeing a broader rotation when it comes to Chinese tech stocks. So you're seeing a lot of investors. They are essentially cashing in on the names that have really fueled the market this year, and they're rotating into some of the laggards. Alibaba kind of being at the center of it all. Now, also, we do know that Alibaba has kind of been viewed as an e-commerce company, but now a lot of investors are viewing it for artificial intelligence and cloud. And so, as you'd imagine, as a lot of these companies are being rewarded for that direction, you're certainly seeing Alibaba being rewarded for the same.
Well, talk to us a little bit about what that means, because when I think about Alibaba, for example, my mind still goes to e-commerce specifically. What are they doing under the umbrella of AI? Is that something that they've actually been able to monetize?
And that's the thing that a lot of investors are essentially hinging on. So we have seen the company actually diving into instant commerce. And so when we think about consumers and they're purchasing things, if they're able to get it, as it sounds,
I'm sorry,
instantly. Instant commerce.
Like I think it and it materializes.
Now, wouldn't that be nice? No, but it's essentially just things being delivered to the consumer at a fast pace. If you think about e-commerce, of course, that tends to be online. So we are seeing the company really leaning heavily into the tech space. And as we think about the fact that the company has been struggling, if you're looking at the stock, it's down about 25% year to date, and we've seen broader weakness. But this all is kind of stemming from the fact that we've seen some really intense competition in the space. Yeah. We also know that in China, they've been cracking down a lot on large tech platforms. So you saw Alibaba essentially getting hit because of that. But when you think about the fact of the company diving into artificial intelligence and the cloud, investors are essentially seeing it as Alibaba's next major growth.
Well, that's what I'm looking at. I mean, at least based on Bloomberg, the Bloomberg terminal, as of March, you're still talking about a company, 54, 64, 70% of their revenue still seems to be tied to e-commerce. The cloud business, only about 15 or so percent. And I don't know where AI actually fits into that. Does this become one of those transformation stories, kind of similar to what we saw with Amazon here in the U.S., which went from being an e-commerce company to basically what is now basically a cloud company that just happens to have a big logistics and e-commerce business on the side?
Well, that's a great question because we haven't seen the company actually fully bounce back. We are still seeing quite a bit of weakness when you take a look at the stock and how investors are really viewing the fundamentals. And so the question is whether or not they're actually able to scale that way and monetize the things that they need to monetize, and what investors are really focused on as to whether or not they're actually able to see some of those long-term returns, especially as we think about the likes of an Amazon.
And you touched on this a little bit, but I mean, in the last 30 seconds we have with you, I mean, this isn't just Alibaba. This is part of a broader rotation that we're seeing across Chinese equity markets.
Absolutely. So we are seeing a lot of investors are rotating into names like Tencent, JD, Alibaba, as we of course mentioned, and rotating out of some of those names that we did see driving a lot of the gains, like Korean and Taiwanese chip stocks.
Yeah, absolutely.
Have you ever bought anything from Alibaba?
I have not. Have you?
I did from Alibaba Express once.
Interesting.
Yeah.
Was it instant?
It was not. It was not instant.
It took a little bit.
It was relatively fast, given that it probably came, from the depths of the China somewhere.
Maybe one day we'll think of it and it'll just pop in front of us.
That's the future I dream of. Nora Melinda, she is our Bloomberg TV markets correspondent. Meanwhile,
you can just go to the store yourself, Katy.
Yeah, I'm never going to do that. No.
Give cash.
My muscle memory is too strong. I go online and I click the buttons. Anyway, coming up, we're going to take you to the closing bell with Katy Kaminski, Chief Research Strategist over at Alphasimplex. This is The Close.
I think what you see is basically just a little bit of an indigestion problem in the capital markets because the needs are so large, right? 600 or 800 billion this year, going to $1 trillion over the course of the next couple of years. So you're going to see a variety of things. One is you're going to see, I think, new issue concessions are higher in the credit market. You're going to see a slight widening in spreads.
Tony Rodriguez over at Nuveen kicking us off to the close just about 50 minutes ago, talking about the ructions in the market on this Wednesday afternoon. We had a lower open for all of the major indices, but we're well off the lows of the days, and a couple of the indices have actually poked back into the green.
Yeah, tech among them. It is an interesting sort of trajectory of the trade today. It looked like you could make the case that geopolitical risk making its way back into the equity market. It certainly has when it comes to the energy markets. But again, 0.3% decline after President Trump says that the ceasefire is over. Not too much of a reaction here when it comes at least to stocks.
Yeah, we should point out the S&P at one point was down 1% on the day. The Russell 2000 still deep in the red, as are the Dow Industrials. And of course, we can't forget, of course, about that third line that you have on your screen, a 6% jump there in Brent crude prices. So we're about 9% higher than where we were just about 48 hours or so ago. Joining us right now to help us count down to the closing bell, Katy Kaminski, Chief Research Strategist over at Alphasimplex Group. And Katy, I do want to start off with the bump up that we've seen in oil prices. Of course, with the big asterisk is we have, of course, no idea what develops next on the geopolitical front. And all of this could, of course, be erased in a matter of hours. But when you see the idea of geopolitical risk still being a factor, how much of that needs to be priced into the market, or is that already priced into this market?
So this is a very good question, but the fact that we saw the markets move relatively substantially today in the precise type of cross-asset correlations that we saw related to geopolitical risk means that it seems that there's still some residual risk of that accelerating again. And people are concerned more about the longer-term sustained shock, or whether or not this doesn't ever dissipate and we keep having this particular move. It is interesting, though, that it was erased quite a bit by the end of the day. Earlier in the day, the story was different.
Yeah, and we should point out, too, obviously, a lot of these moves are still very concentrated in the chip space, or we should say the AI space overall. But today, it's chips, with NVIDIA up about 4% on the day, Broadcom up about 5%. Do you have any concerns about that concentration? I know we've been wringing our hands over this for months now, but this has been the leadership in the market, and at least for right now, it looks like it's going to continue to be, barring some other major event.
Yeah, I mean, this is a good point. And what we've seen is there has been some rotation. There has been investors trying to perhaps take profit, questioning this particular concentration. But the fact that on a day like today, you have sectors like tech and you have chip stocks that are a little more resilient, that means that today's story is more of an oil shock than it is really a growth shock. So I think there's still some legs to that particular AI trade. And I think that's why you haven't seen a bigger pullback already in that sector.
Let's talk a little bit more about that oil shock that we're seeing today, because a 6% jump in Brent, certainly not nothing, but you think about the levels we're trading at here, $78 a barrel. We've come way down relative to where we were. And even at, sort of the peak panic moments, we didn't get up near those $200 levels that some were worried about. And Katy, I wonder how you're thinking about oil right now, because it does seem like a market that wants to be weighed down here.
I mean, I do agree. I think that the market has wanted to come to more sustained normal levels. I think the concerns are moments like today where you see that it's still vulnerable, that, we could see, increased oil prices. The interesting point to me has been, and to many as well, is that the impact of these higher oil prices have been a problem, but not as big of a problem as some points in history. So I think as long as we can keep oil prices within a maintainable range, that we won't see that growth impact, which I think is the really bigger concern, especially for the equity investor.
And what does that mean for the Fed? Because, okay, maybe you don't get as much of a growth hit, but you think about all the different things that oil feeds into. You think about, higher food prices and some of the concerns there. What does that potentially portend for the inflation picture? And how do you expect traders to sort of parse through those different competing forces?
So this is a good question, and I think particularly today it's important, as you had some of the FOMC meetings out to notes today, and this idea that inflation is still something we need to be very focused on. The challenge with an oil shock is really trying to understand how much of that passes through to other asset classes. Last month, we actually got some respite in many of the different commodity sectors, including the agricultural sector. So you are seeing, no clear picture that there's big warnings in terms of inflation uncertainty. But when you have events like today where, that inflation uncertainty comes back into the markets, it just reminds us that, this inflation concern isn't over yet.
I am curious about what we should expect with regards to volatility in the market overall, specifically for equities. Now that we have earnings season about to pick up, coming at a time with the unresolved issues in the Middle East, coming up at a time where a lot of concerns about what the Fed does next.
I mean, I think this is a good point. I mean, volatility is an issue, and I think we can also be a little concerned about summer, where you tend to have sometimes slower periods. And historically, we have, as a quant myself, many memories of extreme days and extreme events in months like August. So I think we should be aware of those type of sort of lower liquidity events, coupled with potential concern for, for inflation risk and other reacceleration. So I think the market could easily tip, and they could be vol events that we need to watch out for.
And I mean, does that apply to every asset class? Or do you think that's particularly pronounced when, you're looking at equities versus fixed income versus energy, for example?
Well, I think it's most asset classes, but equities in particular. There have been certain events historically where, when you have lower liquidity and perhaps quieter periods in the market, you might have, potential for volatility moves just based on smaller amounts of information. So I think that's something to watch before we head into the earnings season. But I do think just the amount of volatility we saw last month definitely caused investors to start thinking that vol may be more elevated surrounding this particular U.S.-Iran conflict narrative.
All right, Katy, always a pleasure. Katy Kaminski, Chief Research Strategist over at Alphasimplex Group, counting us down to the closing bells. Katy, the majority of the stocks in the S&P 500 down, 390 names. A couple of the more important ones are in the green, and that includes NVIDIA and Broadcom, though the S&P now dipping back into the red.
Yeah, certainly that is maybe saving us from worse losses than we would have seen. A different story, though, than we've seen over the past 2 days, where you did see much more improved breadth.
Yeah, yields elevated, crude oil higher. A full breakdown of all of today's market action starts right now.
The Closing Bell, Bloomberg's comprehensive cross-platform coverage of the U.S. market close starts right now.
And right now we are 2 minutes away from the end of the trading day. Romaine Bostick here with Katy Greifeld, taking you through to that closing bell. It's a global simulcast. Carol Massar joins us now alongside Bailey Lipschultz today for Tim Stenovic. Welcome to our audiences across all of our Bloomberg platforms, television, radio, our partnership with YouTube. A wild day in equity markets and really cross-asset markets. Carol Massar here as a market, of course, having to grapple with the re-rise of geopolitical risk.
Yep, on again, off again. That peace accord, on again, off again. That war between the U.S. and Iran. We saw oil prices definitely go up, and that boosted a lot of names in the energy space. Having said that, I think it's kind of interesting in the last few minutes of trading to see the S&P and Nasdaq 100 move up towards its best levels of the day, up about 100 points now on the Nasdaq 100.
Yeah, and the big drivers to the upside: Nvidia up 20 points, Broadcom up 10 points. Interestingly enough, though, we are seeing these chip stocks back in vogue, but we are seeing a bit of weakness, or at least from a points perspective, underperformance for the likes of Microsoft and Google.
Yeah, it's going to be interesting to see, how long that chip outperformance lasts when we sort of flip back. We've been talking a lot about this pair trade that has developed when it comes to the hyperscalers, to the chip stocks. It feels like they've been trading leadership for the past couple weeks. Have to imagine that's going to continue.
Absolutely. And of course, we talk about everything going on in the cross-asset space with that rise in oil prices and the rise in yields, which of course, I don't know, maybe that changes the calculus for how some of the people look at valuations. I guess my question is, were people really looking at valuations on some of these names, Carol?
It doesn't feel that way.
Yeah.
They seem to be willing to jump on board. It doesn't really matter.
All right, well, we get the closing bells in New York, and let's just face it, it could have been a lot worse. All of the major indices today open in the red, some of them very deep in the red, and all of them are going to finish well off the lows of the day. The Dow Jones Industrial Average among the worst performer, down about 580 points, or about 1.1%. The S&P 500, which had been down as much as 1%, is going to close the day only down by about 0.3%, 74.4857 to be precise. The Nasdaq Composite and the Nasdaq 100, each which were deep in the red earlier in the session, both finishing in the green, up about 0.2 to 0.3%. And the Russell 2000, Carol, that's going to end lower by about 0.9%.
All right, so just shy of 1% there on the Russell. Hey, let's go back to the S&P 500. Katy, most names in that average, almost 400 to the downside today, a little bit more than 100 to the upside. So you definitely saw more of a risk-off trade, and it was just some big names, a few names maybe just altering that index.
And that is exactly the story that you see when you take a look at the circle, which shows the sector performance. Information technology, that is the big green slice that you see there, higher by about 1.4% as a sector. You also saw energy, as expected, rise as well, also a gain of 1.4%. But when you look at all that red, the worst performer on the day as a sector, it's interesting. It was actually materials, down 2.5%, but financials not too far behind, down about 1.9%. Overall, Carol, 9 sectors in the red, just 2 in the green.
Yeah, and financials, of course, we'll start to get a read on them next week with big bank earnings. Let's go to some of the individual gainers in today's session. Kind of a no-brainer. I had to talk about some of the energy names. You had Chevron, that name rallying in a big way, up just about 1.1%. It was up as much as 2.6% earlier in the session. Occidental, another major player there, up as much intraday, 6%, finishing the day with a 3.7% gain. But this, of course, has to do with increased tensions between the U.S. and Iran, attacks going back and forth. President Trump saying the war isn't necessarily still on, but it doesn't sound like they're moving closer to resolving it. So reigniting that geopolitical risk premium in prices. We did see oil prices above $80 a barrel for both WTI and Brent. So certainly playing out in the energy patch. I'm going to go over to the chip names. Broadcom, we saw that one. It was a top performer, and I think both the S&P and the Nasdaq 100 throughout the trade today. Earlier this morning, Apple saying its chip agreement with Broadcom will exceed $30 billion, not too shabby. The deal will involve manufacturing more than 15 billion chips in the United States, supporting hundreds of jobs, and Apple will help Broadcom upgrade its production facility, specifically in Colorado. The partnership will include $1.5 billion investment in that Broadcom plant in Fort Collins, Colorado, to build advanced radio frequency components for wireless chips. So anyway, getting some more numbers around that, and that looks pretty impressive. And then I'm going to go to a name that Bailey brought up to me earlier in our team this week, TeraWulf. Ticker is WULF, and it's up about 13%. Morgan Stanley raising its price target on the data center operator following the Anthropic lease deal. Maintains an overweight price target raised to 72 from 66.50. Stock closing just below $23 a share. The analyst, Stephen Bird, sees the Anthropic deal as attractive with high equity value creation. Stocks up more than 90% year to date. 27% of the float is short. Just a little perspective there.
Just a little bit. Carol, on a day where almost 400 members in the S&P 500 are in the red, you would think I would have more to choose from. But we'll look nonetheless.
He was whining a little bit earlier.
I enjoy complaining. It's my personality. But as you mentioned, energy outperforming, so that has weighed on airlines, cruise lines, as well as hotels. So looking at that airline index, as you can see, down 1.8%. Every member of the index in the red. Worst performer, American Airlines, down 4%. Alaska down more than 3%. And going to call out the fact that United and JetBlue both underperforming. Obviously, higher costs as it relates to oil, as it relates to jet fuel, impacting their bottom line. It seemed like we were finally getting out of worries around higher ticket prices for consumers here in the U.S. and around the world. Does not seem to be the case, and I want to stay on that topic and look at Norwegian Cruise Lines, ticker NCLH. Ended the day down 1.9%, not a huge drop, but was down at one point more than 4%. Investors kind of rethinking what this ultimately could mean. Norwegian Cruise Lines, very much exposed to a wealthier clientele and also a clientele that typically travels around the world, so not necessarily catering to the U.S. consumer. So certainly something to keep an eye on. And Carol, my favorite stock, because I covered the IPO, SpaceX, ticker SPCX, down 0.8%. Main thing to call out, 3 days consecutively down 8.5%, has been in the red since it was added to the Nasdaq 100. Only up about 9.8% from that IPO price. So a little bit of consternation going on over at the house of Elon Musk.
It's a shame the street isn't bullish on this name.
We take a look at the yield space here real quickly. Basically a parallel shift once again for a second straight day. A little bit more modest of a shift today, up about 2 basis points across the board. But we should point out that the moves that we've seen over the last couple of days in the Treasury space having a big impact on equities. We saw that reflected in the downdraft in financial stocks, and you actually saw that reflected in what is now, I believe, a 3-day loss that we're seeing in home builders.
All right. So, hey, thank you so much for that, home builders. Because listen to this, everybody. A low birth rate risks creating a U.S. housing glut. You heard that right. Over the coming decade, a new era may be dawning in which a shortage of buyers, not homes.
Katie, you know nothing about that.
Is a defining feature. It's a new white paper out from Mortgage Bankers Association. You've been looking at properties, right, or looking for a home?
I'm someone who's currently pregnant and literally trying to close on a house right now.
Did you write this story, Katie? Is this you?
I wish there was a housing glut right now. But over the next decade, I mean, Carol, as you pointed out in our chat, that sounds great if you're a buyer.
Correct.
Yeah.
You're a seller, not so happy.
Yeah.
Right?
As someone who has owned a house for a few years and is already thinking about what I could afford in the future, it's pretty doom and gloom, I will say. Over in West Orange, the one thing that does stand out, are we going to get mortgage rates still stuck around 6.5%? Katie, I don't know what you're thinking about when you're talking to your loan broker, but not a great for the bottom line if compared to where things were a few years ago.
It's not so much thoughts as just, screaming and static. Anyway.
Don't scream. You got a baby in your belly.
All right, well, don't worry. And maybe in the next 10 years, Katie, things going for you and Bailey. Meanwhile, back here in New York City, I know a lot of our viewers are haters on Zohran Mamdani, but he's actually trying to make some improvements to the transit system, but this time with buses. I'm not sure how I feel about this. So he wants to give city buses more dedicated lanes, like priority lanes is what he's calling them, which basically means I can't drive in those lanes, which I thought we already have these here.
I thought we did too.
Yeah, I feel like half the avenues in New York are now like one lane of traffic while it's just, the buses and everybody else gets the others. So apparently he's going to expand this. And the idea is they're going to be faster, I guess, in theory.
It's actually called Next Stop, Fast Buses, Better Service, which I don't know.
It's great branding. Whoever got paid for that, congratulations.
Yeah, I don't know. I feel like they could have come up with something
It's like
snappier.
how many McKinsey consultants does it take to screw in a light bulb? Is it going to be faster?
That's the hope here. I mean, the goal is to cut riders' travel times by up to 6 minutes on about 50 priority routes here.
Down
and
from
I mean, from
I need a
gazillion minutes,
Okay,
probably. There are a lot of these priority bus lanes, but I feel like it's not really enforced. I feel like I see people.
Well, they put cameras on the buses now that give you tickets.
But it's
then
also,
people get around them by lifting up their trunk. If they park in the lane, just lift up their trunk.
But
So
it's
you
also
can't read the license plate.
traffic signals that prioritize buses, expanded all-door
Yes, I've seen
boarding,
that,
and investments in new buses and amenities to improve service. I don't even know what that means.
I would love. Is that an iPad? Are we like watching TV on these buses?
I don't know.
Be kind of cool.
I gotta ride one of these buses one day.
Oh,
Are they
okay.
clean?
Oh yeah. You're gonna say no to the limo and gonna get on a bus?
Yeah. I rode the subway the other day, Carol.
That's good. Man of the
I did.
people.
I was, yeah.
Well done, Romaine. Well done.
Yeah.
All right, guys. That is a wrap. Our cross-platform
I was
radio.
nervous the whole way.
Radio, TV, YouTube, Bloomberg Originals. Hey, let me know next time. I'll go with you and protect you, I promise. Katy and Romaine finishing there on The Close on TV, and Bailey and I back here on Bloomberg Business Week Daily. We'll see you again, same time, same place, tomorrow.
When we come back, we're going to break down another volatile day on Wall Street. George Maris over at Principal Asset Management is going to be joining the program when we come back after the break, right here on Bloomberg.
The countdown is on. Everything you need to get the edge at the end of the market day. This is The Close.
Welcome back to The Close. I'm Katy Greifeld.
And I'm Romaine Bostick. Another volatile day on Wall Street. You did see some dip buying late in the session, but most of the major indices did finish in the red. The Nasdaq 100 and Nasdaq Composite did poke into the green towards the end of the session. The S&P, though, could not quite get there, down about 0.3% on the day. And we saw some of the subsectors really get hit hard. That included financials, that included a lot of travel stocks, and it also included materials. Of course, a big part of that reason was the bump up that we saw in yields, and more important, the bump up that we saw in crude oil, which actually, as we speak, Katy, seems to be intensifying, now up about 6.5% on the day.
Absolutely. As you mentioned, that really impacted the travel stocks, and you can see that in Carnival shares down by 3.9% on the day. And again, this was an airline story, this was a cruise story, travel stocks in general taking a hit as you saw oil jump here. I wanted to highlight Bloom Energy, down by about 5.7%. Hunter Brook coming out and saying that they're short the stock. That sent shares lower. NVIDIA, though, sort of the saving grace of this market. It's been seeing a lot of volatility, but NVIDIA shares closing higher by 3.7%. That was your largest contributor to the upside on a points basis on the S&P 500. But that's our top story this hour, that tech turbulence hitting a dot-com extreme. Volatility in the Nasdaq 100, as measured by the Cboe NDX Volatility Index, hitting its highest level relative to the VIX since 2002. Here's what Mandy Zhu of Cboe Global Markets had to say on market swings yesterday.
The volatility that we're seeing in the market right now is very specific to certain sectors, and it's very specific to the stock level. Market-wide risk, as measured by the VIX, is fairly muted, but there's a lot of risk at the idiosyncratic stock level, and there's also a lot of risk, obviously, with the tech trade.
And on that topic, our next guest says that volatility is a feature, not a signal, with equities adjusting to persistent episodic volatility, Romaine.
Absolutely. That man is George Maris, Chief Investment Officer and Global Head of Equities at Principal Asset Management. He joins us right now. And George, that is where I want to start. We kind of got a taste of that over the last 24 to 48 hours with regards to that episodic volatility, this time driven by geopolitics. What gives you the sense here that this is just the new normal that we're going to have to live with?
Yeah, Romaine, first of all, thank you for having me. I think there's several things that cause the observation that volatility and significant volatility will just be with us going forward. First is we do have a market where we have in somewhat of a good way, but somewhat of a challenging way, democratized who can play. Things like Robinhood, et cetera, have allowed people access to markets in a leveraged way that we just haven't seen before. Moreover, we've seen financial innovation allow all sorts of systematic strategies to aggressively trade. So we're seeing a greater degree of short-term trading as a proportion of trading than we've ever seen before, and it's only exacerbating, right? And so those structural features are with us. They're not going away, and they're going to create more volatility. In addition, we see, we've got a 24/7 news cycle. Everyone's got information. So if there's a geopolitical event, a policy change, something happening with a company, something structural, like that hits right away, and it just impacts markets immediately. And with that 24/7 news cycle and all of the financial innovation that's democratized things and created the use of leverage tools, we're going to create heightened structural volatility in markets. It's just a persistent feature for us.
Well, speaking of that, hold that thought, George. When I was standing at the board, we had seen a big spike, modest spike, I should say, in Brent crude prices. They had jumped about $1 just over the past few minutes, and we're now learning, based on a report by Axios, that the U.S. has begun strikes in Iran for a second straight evening. So something to keep an eye on there. And this gets to this idea, George, as to whether investors should sort of heed these types of events, or do you find a way to look through them, focus on whatever your long-term strategy is?
Yeah, so there's a balance, right? We've got to understand whether these events are going to create long-term either value creation or value destruction, right? What's really cool or what's not? What's going to be dangerous? I think the 24/7 news cycle we have, and this isn't to blame you, right? It's just a feature of where we are, where information is so quickly disseminated and then transferred into markets, means that everything hits, and it hits with an immediate impact, and it hits in an exaggerated manner. So I think that the prudent investor should be looking at what's creating value, what's not. If it's noise, and we know the signal to noise ratio is awfully low. If it's noise, to ignore it, and in fact, use that volatility to your advantage. Take contrarian positions that might not otherwise have been available just a matter of years ago.
Well, if you think about some of the episodic volatility that you're mentioning, and I wonder how market structure plays into it, because it sounded like you were alluding to, some of these leverage products that are out there heavily used by retail, which is really just a phenomenon, especially when it comes to the ETF side, that has really only arisen in the past few years, George.
Katy, that's exactly right. Look, we can look to Korea for a phenomenal example of what that leverage can do to markets. It is no longer surprising to see the entire Korean stock exchange, the Kospi, move 4, 5, 6% on a single day. For the second largest emerging market, economy, that's not normal. Right? And why is that happening? It's because of the incredible amount of these leveraged vehicles, these leveraged ETFs, double and triple levered ETFs that are in the hands of retail speculators. And that's creating this volatility. Again, that's going to be exacerbating moves up and down. It can create a lot of indigestion near term, but it creates lots of opportunities, lots of arbitrages available for folks who can look out and not even look out that far over time just because of the short-term orientation of this type of activity.
Well, that's something I've been wondering, whether the volatility that we're seeing, this sort of tail wagging the dog effect, whether you could make the case that we're going to see that come stateside, whether we're already seeing that come stateside. And I think about SK Hynix, for example, with their own planned stock offering in the U.S., potentially adding to that story.
Yeah, Katy, I think it's already stateside. I think what we're seeing in Korea is an exaggerated version of what we're already seeing stateside. But you can all look at the meme stocks that we've had over the last several years. That's a phenomenal example of this kind of hyperbolic activity. We could see it in the trading today, right? We'll even go back. When you have mega gigacap stocks that move 10, 20% in a day on an analyst changing a price target, like that's not rational. That's not healthy. What's driving that? That's being driven by leveraged vehicles. And I think so it's already here, and it's something for us to take account of. And, again, something to note and take advantage of if you're able.
Well, George, would love to pick up this conversation again soon. That is George Maris. He is Chief Investment Officer and Global Head of Equities over at Principal Asset Management. Now coming up, results from Levi's putting the spotlight on retailers. Alex Straton of Morgan Stanley breaks down what to expect from the sector this earnings season. This is The Close on Bloomberg. Well, we're keeping an eye on shares of Levi's down sharply in after-hours trading following results from the apparel company actually raising their outlook and their dividend after sales outpaced expectations. But you can see shares currently down by about 4 to 5% after hours. But Levi's is just one of the first retailers to report this cycle. And our next guest is bullish on the specialty retail and department store subsectors as we head deeper into this upcoming earnings season. Alex Straton, Equity Research Managing Director over at Morgan Stanley, I'm pleased to say, joins us now. So, Alex, again, it's just the start of earnings season. We're almost there, and I'm curious, as we head into this next reporting quarter, what companies, which of these names do you think are best positioned to weather what is still a pretty challenging macroeconomic backdrop?
Sure. So I think where I'll start is just generally speaking, we're bullish these two subsectors out of those that I cover. So that's specialty retail and department stores. And that view really stems from this idea that there's an improving setup as we're moving into the back half. And what's underpinning that is a few things. One is an early cycle environment. Our stocks are outperformers in early cycle environments. Our U.S. equity strategists here at Morgan Stanley are even more convicted in that environment coming to fruition. Second is what we see as generally fair to beatable estimates, so call it a positive revision story at play. People have set relatively low bars. Third, consumer and earnings tailwinds that we see that we don't think are totally appreciated, which we can get into. And then fourth and finally, it's really all this coming against really depressed sentiment and valuation in the space. We're at last 12-month lows, below 4-year trading averages. And you take that against what's also a typical seasonal rally into year end. Our stocks are almost always outperformers, really starting in like mid-September-ish onwards. To me, that makes for a very favorable setup, and it's why we're bullish, broadly speaking, on this group.
Yeah, well, let's talk a little bit and name some names, because I see the names that you're overweight include the likes of Macy's, Tapestry's on the list as well. What do those sorts of companies have going for them that, is differentiated from a Kohl's or a Lululemon, which is on your underweight list?
Sure. So you're calling out a couple of the stocks that we came out overweight on. And just so it's totally clear, Macy's, Tapestry, Urban Outfitters, and Victoria's are our top overweight calls. I think Macy's is the most interesting. And really, the reason why we're landing there is we don't think that the market is fully appreciating the power of their turnaround transformation and how it can impact growth for the business. Basically, the market is saying this is a structurally declining retailer. And the work that we did around their reimagined store base and also a turnaround tracker we put together, in addition to what I would call somewhat of a last man standing dynamic in department stores, means that we're willing to underwrite a path to either revenue stabilization and or growth, whereas the market and consensus are modeling basically permanent declines. And Macy's, I think, is a great example of why we're positive, because it also explains on the other end on some of the names where we think the market and consensus is overappreciating a turnaround or a stabilization. And that's really what we see at something like a Kohl's or a Lululemon, where we've taken an underweight stance.
Well, I am curious too, and particularly on Macy's, just overall. I mean, I think it was a couple of years ago on Abercrombie, maybe about 3 years ago, you made a pretty prescient call on Abercrombie about its turnaround, and there was a pretty wide gulf between your view at the time and Wall Street's view. Obviously, we've seen that gulf narrow based on their results here. So, what do you sort of look at? I mean, what are kind of the ingredients that you look at for some of these businesses that have maybe struggled about their ability to actually turn around and get back to growth?
Yeah, look, this has been an adventure for our team in the last 5 years, is how do we develop trackers or momentum checkers that are looking at data points intra-quarter that could be indicative of some sort of inflection in advance of when you see it in fundamentals? Because by the time you see it in fundamentals, the stock has already moved. So things that we're particularly focused on are metrics like how the customer base is evolving. So if you're able to capture new customers, if you're able to capture a different demographic, I think the demographic piece is really interesting because it can work both ways. For example, Abercrombie targeted an older consumer and that worked. Tapestry targeted a younger consumer and that worked. So you have to be nuanced in how you do it. But I think customer metrics are really important. We look at social media metrics to understand kind of momentum in advance of potential sales inflection. And there are a number of other data points that we look at. I think those two are incredibly important when you think about a turnaround, because it's, are you capturing someone new with a new brand perception? So those are just a few that are in our Macy's turnaround tracker. Yeah. And really where it shined was in the Bloomingdale's division. And Macy's is kind of, I'll call it a yellow light there.
Hey, Hey, real quick, Alex, we only have about a minute left. With regards to more of the economic issues, whether it's tariffs, gas prices, et cetera, any concerns for the rest of the year about how that could affect some of these companies?
Yeah, I think, we're in touch with our U.S. economics team regularly, and they're more optimistic. And I think generally the world a little bit more optimistic on the gas price situation. So I think if anything, we're more in the camp that could be an incremental tailwind in the back half. And then on the tariff front, I think I'll approach it from a company perspective. I think there's a twofold type of tailwind you're getting. One is potential relief in terms of refunds. And the second is you're lapping a base that already includes that and now often has lower rates.
Yeah. Alex, always a pleasure. We'll talk again soon. Alex Straton there, Equity Research Managing Director, covering a lot of these retailers over at Morgan Stanley. When we come back after the break, we're going to take a look at Meta. Obviously, a big report last week by Bloomberg about its cloud ambitions, and a story today about a new data center it's going to build out there in Canada. A conversation up ahead with Mark Douglas, the CEO over at Mountain, after the break. All right, we learned just a few minutes ago that Meta is set to invest about $10 billion to build its first data center in Canada. Now, this news comes 1 week to the day after Bloomberg reporters talked about how the tech giant is looking to support its AI ambitions with a cloud infrastructure business that will sell access to AI computing power and models. That's according to people familiar with the situation. Meta has not confirmed it. But our next guest is raising concerns about Meta pouring money to enter an already competitive space that is dominated by Amazon, Microsoft, Google, and others. He's the CEO of the ad tech company Mountain. Mark Douglas joins us here in Studio 2. Mark, great to have you here.
Thank you.
Obviously, in the business you're in, you cover a company like Meta a lot. Obviously, it's an advertising juggernaut, but apparently, at least if you believe the Bloomberg reports, it wants to be more than just an advertising juggernaut. It wants to be a cloud juggernaut.
Yeah.
You're not hot on this idea.
Well, I think there's a couple ways to look at it. I think a lot of people think just AI infrastructure is possibly getting overbuilt. And so everyone else has a way to deal with that, which is they can sell excess capacity, and Meta does not. So in that regard, kind of teeing up the possibility of doing that is very smart. Remember, SpaceX or xAI, they did that with Anthropic, and it's like kind of a fabulous deal for them. But I think of Meta going into the infrastructure game against AWS, against Google Cloud, at this stage, that's going to be very hard. And remember, the switching costs for companies are huge. To switch out of one to another are like multi-year projects at this point. It's very expensive.
When I first saw the story last week, my first thought was, is this somehow indicative of issues with the core business right now, the ad business, the idea that maybe they see a slowdown there and they want something to diversify? Or is this just Zuckerberg doing kind of what he typically does, which is just throw something at the wall and see if it sticks?
Yeah, I mean, Meta and I guess you can say Mark Zuckerberg have always been ambitious about fast following other businesses. They ironically, their biggest business, which you think is Instagram, that was a fast follow. They bought that. Probably the best acquisition in history.
In hindsight, that was great.
But I think their ads business is not slowing down. If anything, it's growing at a phenomenal rate at their scale. And I think it's believed they're going to become the world's largest advertising company this year, overtake Google in terms of ad revenue this year, which is just a phenomenal accomplishment.
Is that because of Meta's growth or Google's sort of lack of growth?
I think it's because of Meta's growth. If you think of, I've always said, if you take Google, their search, where you just type in the name of a brand and they give you search results, that's like half their revenue. If you take that out, Meta's already bigger than Google, because putting ads against someone typing the name of a brand without .com on the end is not, that's not it's a lot of money, but I don't think of that as bringing new consumers. But Meta is bringing new consumers. They bring it at scale, and that's what every business wants. There's no company that enters any market and doesn't consider, okay, I got to advertise on Instagram.
So, tying those two things together, I want to make sure I'm understanding your argument. Are you saying that Meta should just focus on this very successful ad business and not get distracted by going into the cloud, et cetera?
Yeah, I think Meta has to be an AI company, and I think, and their ads business is at this stage very dependent on AI. But, Meta going into like cloud hosting even for AI, I don't, if I'm an investor, I'm not penciling in revenue targets for that. I just don't see that materializing over time. At best, I'm saying at least I can hedge all the cloud's investments they're making, which at this point I think are like over $100 billion in infrastructure costs.
And it's a really interesting critique because I think you think about this moment in time, the conversation being had, all these concerns about whether we're overbuilding. You think about this data center build out, whether in hindsight we're going to look back at this period of time and say, man, we way over-egged, how much capacity we actually need here.
Yeah, I think there is no doubt that we are overbuilding in the United States. Whether we're doing that worldwide, I think that could be argued, but putting data centers in the United States with expensive energy, expensive land, resistance to the data centers, versus putting them in other countries that are welcoming those data centers, I think long-term it's not going to make a lot of sense.
But I've heard this argument about the idea that, okay, maybe we should be building these things in more lower-cost countries, et cetera, or maybe space, depending on if you believe Elon Musk. But I was always under the impression that these data centers also had to be in relatively close proximity to whatever the end user. Is that not the case?
Not for training data.
No,
for internet access, yes. Yeah. Even though data moves at the speed of light, it passes through so much infrastructure that distance does matter. But when you're training models, you're housing vast amounts of data. That data can be located anywhere. Now, the real issue there is, well, if the data is located outside the U.S., does that violate any laws? So I think you're going to see the development of a concept of data embassies, where a data center located in another country is actually treated as an embassy of that country. And that's a concept I know for sure is being worked on in a number of different countries.
I am curious, though, too, just going back to this decision, or at least, again, not decision, I should say, the reporting by Bloomberg about this decision. Is there a sense that this could also be an advertising play? The idea that, I mean, we've heard from advertising, you can tell us, I mean, you run an ad company more or less. It's AI tools or the technology that we're seeing them build out. I mean, I would think to a certain extent that has the ability to enhance the advertising process, whether it's discovery, whether it's placement, et cetera, et cetera. Is that potentially a play here?
Well, I mean, it's all at play.
Yeah.
I mean, but the thing, going back to the whole point, the question of are we overbuilding? Every one of these companies is estimating that their share of the market is essentially going to be 100%. They're all saying AI is essentially going to be size of the current global economy, or what these estimate, like $28 trillion estimates, or at least that was SpaceX's, estimates.
I lost track of their estimates.
Okay, so if they're all building towards that number, someone is overbuilding. Like they're not all going to get there, and I think that's the point. Is that ultimately we are. And we saw this 25 years ago when the internet was built out. There was just vast amount of fiber laid and things like that. Then there was too much, and then eventually there wasn't enough as the reality. It's like reality. They went ahead of reality, got in over their skis, meaning all the people building out the capacity. Eventually that collapsed, but the world eventually caught up, and I think that's what you're going to see here. Meta, in a sense, is being back on that original point, is being smart in saying, look, we can't be the only ones without a backup plan.
Right.
Okay. Fair enough.
Google has Google Cloud, Amazon has AWS, and so.
I thought Meta was going to have the glasses or something. Isn't that their backup plan? You don't have a pair of those.
I do have.
You do have a pair?
Yeah.
Okay. All right.
I think they're actually phenomenally good headsets. People forget the little speakers built into.
Oh no, we know. Our senior producer wears them. We can hear.
I don't take many
as she's
pictures
walking
with them,
around.
but I listen to do phone calls on.
Do you really?
There you go. So there's a use case there.
Yeah, they'll walk down the street to Manhattan doing that, though. You might get arrested.
You might get some love.
Exactly.
Mark, while we have you here, we have to talk a little bit about the World Cup as well. Of course, I think there's still a lot of salty Americans out there after the U.S. got knocked out. But talk to us about.
Were you actually rooting for America?
I mean, yeah.
Because okay, all right.
I was rooting for America, and I have to say, I was rooting for North America, not just North America.
There you go.
So I was really into the Mexico game also, and I was disappointed when they lost too.
disappointment all around. But talk to us a little bit about what this has meant for Mountain, what your involvement with the World Cup and, you know, all the associated fanfare around it has been.
Yeah, absolutely. So we started the year really for the first time wanting to put small and mid-sized businesses into major sporting events, because normally they'd be cut out of that kind of inventory. And so we launched a product we called Select, and which enables any size business to get into events like the March Madness, World Cup. So we have many of our customers advertising in the World Cup. The CPMs, the prices are similar to what the largest advertisers are paying, but they don't have to drop $1 million to do it.
Well, but how do you do it? So you're saying like during the matches?
Yeah, during the matches.
Yeah. And they can afford that?
They can. They're allocating budgets. The budgets are anywhere from $100,000 to $1 million. And these are brands that traditionally would not be in a sporting event like that, but it makes sense for their brand.
Just real quickly, I mean, what's the kind of the stickiness of that? I know, I mean, obviously in the U.S., the Super Bowl is like one of those sort of, you know, kind of completely transcendental kind of advertising thing, because people will watch the ads and not even watch the game. With something like soccer, international football, do you see the same type of interest in terms of eyeballs on those ads?
Yeah, and you get an interesting phenomenon, which is major sporting events have a lot more people watching per television. So remember, we're doing television advertising. So our product, you know, is very, very targeted. It's like we're putting ads in front of the exact right person. But when you do it in the World Cup match, there might be 4 or 5 people in the room. So you're getting a lot more reach for the same amount of spend. And so and I think for a lot of our brands also, there's a lot of credibility attached to being attached to these events. And so there are numerous reasons. The revenue it drives, meaning the performance, the additional eyeballs, the credibility, it all contributes to. There's a lot of emerging companies that now, through Mountain, now have access to events like that. And so it's something we're very excited about.
All right, Mark, gotta leave it there. Great to get some time with you on set. That is Mark Douglas. He is the CEO of Mountain. Meanwhile, let's take a look at how markets closed out on the day. The S&P 500 falling about 0.3%. You can see the chip makers, though, really roared back. The Philadelphia Semiconductor Index higher by more than 2%. You did see that rise in oil at the bottom of your screen. That's continuing after hours. Brent higher by 7%. That did put some upward pressure on the 2-year Treasury yield. I do want to check in with some of the big ETFs after hours, though, because we are getting reports that the U.S. military is launching strikes on Iran for a second straight day. You can see that's weighing on sentiment after hours, SPY cues, and also in ETF tracking the Russell 2000 lower as well.
I just want to bring another headline to the attention of our viewers. The state-run media agency in Iran is saying that they are now launching large-scale retaliatory ops on U.S. bases, so we'll keep an eye on that.
Toyota moving production of its Tacoma midsize truck to San Antonio, Texas from Mexico. Our next guest was instrumental in spearheading that San Antonio plant during his time as the city's mayor before launching into national politics. Joining us live, I'm pleased to say, is Henry Cisneros. He is former Secretary of the U.S. Department of Housing and Urban Development, now Vice Chairman and Equity Partner of Siebert Williams and Shank. Fantastic to have you with us. So you were mayor of San Antonio from 1981 to 1989. My understanding is that this is groundwork that began to be laid in the mid-1980s. So walk us through, you know, that period of time and how that brings us to this decision from Toyota today.
I started trips to Japan in about 1985 and had the good fortune to team up with people within Japan who were close to Toyota. So in the annual trips that I made thereafter, we always called on Toyota. We were very fortunate to develop a relationship with a lady who was a business consultant, but also a member of the Mitsui family. And her first cousin was married to Dr. Toyota, the CEO of Toyota. So it was a business relationship, but it got to be a very personal relationship. We became dear friends. And about 16 years later, in 2001 or 2, Toyota began to talk about an actual plant somewhere in the United States, an additional plant to what they already had in Kentucky and Indiana and other places. And legend has it that they were considering Texas. And one day, the leadership of Toyota executives went to a Dallas Cowboys football game, and walking through the stadium parking, they could not believe the number of pickup trucks in the parking lot. And they said they must sell an awful lot of pickup trucks in Texas. And as a result, decided to select San Antonio, which we were very, very happy about. It went into one of the poorest areas of the city, a school district that badly needed the revenues, the job training programs we put into full motion. And bottom line is, created a plant that produces now about 240,000 tundras and sequoias. And this new investment of $3.6 billion will add a Tacoma line. So this is when you're in my position, early involved in Toyota, I would have never dreamed it would be this significant, this important, and have the potential to expand in this way.
And so the president obviously thrilled about this as well. President Donald Trump posting on social media that this is a really big deal, also saying it showed tariffs at work. And listening to what you're saying, it sounds like that's not the complete story when you think about, how long-term this relationship has been.
Well, it's not the complete story because it did start a long time ago, and Toyota saw the value of being in the United States. There may be some element to the president's point that more and more companies want to build within the United States. And so they had a choice of being United States adjacent in Mexico or actually building in the United States. That may have been a factor. I did hear the president this morning in a press conference from Turkey talk about this Toyota decision in our city. So that that put us in a global conversation for the day.
I am curious, though, Mr. Cisneros, about this idea, though. If we move away from a more formal NAFTA, USMCA type of agreement to these sort of periodic reviews that the Trump administration is looking for, does that create the potential of more companies effectively, I guess, just picking a side of the border? And obviously, with the U.S.'s economic size, does that then become the default for where they go?
Well, let me just say I'm very hopeful that we don't reopen the USMC at this point.
Well, it's reopened already.
Well, reopened in the sense of actually taking some action to negotiate key sections, because it's been functioning, and it's created, at least in our region, massive rewards. The Laredo, Texas, is the busiest crossing point in the world for cargo and goods between any two land ports, between any nation in the world. And all of that volume comes up IH-35 into Texas. There is a automotive cluster now that exists between San Antonio and Monterrey in Mexico and other cities, Saltillo, Querétaro, and others in Mexico. And it's employing literally hundreds of thousands of people in that cluster. And I think that's the best way to create a peaceful discussion between Mexico and the United States. The whole focus has been on immigration, it's been on drugs, but it really ought to be on creating jobs and improving the quality of life in the region. And that's actually working. It's actually happening.
Well, I am curious. I do just want to get your thoughts about the original NAFTA agreement. And I know you were a HUD secretary, but I mean, you were in the Clinton administration at the time when NAFTA took effect and basically it was being implemented here. What did we get right about NAFTA with the benefit of hindsight, and what did we get wrong about that original agreement?
I think what we got right was creating some open trade relationships that have, on the whole, created new manufacturing centers and new investments. What might have been wrong was insufficient attention to the workforce issues. There were programs that needed to be put in place for displaced workers wherever displacement did occur. There was a need to really bulk up on the new economy jobs and prepare people for computer training and other jobs that now we can see are growing in places like Columbus, Ohio, and Akron, and Chicago, and other parts of the Midwest. So that probably was delayed longer than it should have been. But on the whole, U.S.-Mexico trade is vitally important to our country. U.S.-Canada trade is vitally important to our country. And the less disruption of the playing field in terms of trade war or interest rate issues or other bureaucratic obstacles, I think the better for our own country. We're seeing, again, I'm talking now about my part of the country, an automotive cluster in San Antonio that is not only this massive Toyota cluster, but includes JCB, a British tractor manufacturer, Navistar, the old International Harvester with a truck plant. And so now we're back in business in this part of the country with advanced manufacturing.
All right, Mr. Secretary, we have to leave it there. Hope to talk again soon here about a lot of the other issues and projects that you've been involved with. Henry Cisneros there, of course, he used to run the U.S. Department of Housing and Urban Development, now has his own investment firm and is vice chairman and equity partner over at Siebert Williams and Schenck. We'll be back in a moment. We're going to set you up for what the markets are going to have their eyes on over the next 24 hours right here on Bloomberg. A volatile day on Wall Street, and we continue to keep an eye on what's happening in the crude markets and what could potentially happen overnight in the Strait of Hormuz. Meanwhile, in more traditional spaces of the market, we're also keeping an eye on earnings, and we're going to get two in the consumer space, Katy. That includes Aritzia, the apparel maker, and PepsiCo, which is the Pepsi maker.
Yeah, looking
They make
forward.
snacks too.
Yes,
Yeah.
that's true. A broad portfolio over there at PepsiCo. Different angles to approach the consumer. We're also going to get some economic data at 8:30 a.m. in the form of jobless claims. Of course, we're still reeling from that jobs report we got last week. And then 10 a.m. existing home sales update.
Yeah, that should be interesting too. I mean, there's been a lot of back and forth with regards to some of that data in terms of the health of the housing market here in the United States. We're all going to get some Fed speak. I know you love that. We're going to hear from Logan. We're also going to hear from Williams. And of course, we'll bring you any breaking news out of anything they have to say that potentially moves the market.
And then 4 p.m. tomorrow, I believe, the FIFA World Cup quarterfinals begin. France versus Morocco. Difficult counter-programming for us to compete with, but boy, we're going to try and do our best here.
Yeah, this kicks off the 4 days of the quarterfinals. I would just say to say, I mean, not that I'm rooting for anyone in particular. I mean,
but
let's face it, nobody goes over Zimbabwe. But it's kind of good to see. You have the 8 African nations coming into this. They all have played well. Morocco kind of the last person standing there. So we'll see if they can do it. We'll be back tomorrow, right here on Bloomberg.